Welcome to In It to Win It. This is Steve Barton, and thank you for tuning in. Michael Oliver, founder of Momentum Structural Analysis, is a leading expert in financial market trends. Known for his momentum-based analysis, he identifies key market shifts across commodities and equities. With decades of experience, we will be picking his brain and asking the questions you submitted. Michael, thank you for coming back on the show.
Good to be back, Steve.
Yes, sir. Pleasure is all on this side of the table. Thank you. And let's start out like we always do. And what is your macro view of the world economy and financial markets today?
Well, I think the world is linked. So, if you think, if the U.S. goes into recession, it's just the U.S. That's already been talked about by some economists, and we've suspected it for a long time. And I don't even know if the word recession will be applicable once it's deep into it. But we see the same situation setting up stock market wise with two other bubble markets in two key economies of the world. One is in Japan, the Nikkei 225, and the Sensex index in India, another major economy. They have both effectively replicated what the U.S. stock market has done in terms of becoming a bubble, massive bubble, since 2009. And it's one, I've said this before, and I'll say it again, it's the biggest bubble in U.S. stock market history in terms of age, 15 years, and dimension in terms of multiple gains. S&P went up like 9-fold from 2009, and Nasdaq 100 went up like 18-fold, okay? There is no prior, what we call bubble top, like 29 or .com or anything that is anywhere comparable to the age and to the upside distortion of this one. And you could say, well, it was a good economy. We had Obama, we had Biden, so forth, so on, and then Trump comes in and starts down, right? Okay, that's kind of flips it upside down. But the point is that the Federal Reserve is a key factor here. The central bank, the artificial pricer and quantifier of money. We like to call ourselves a free market economy, and so does Europe. But when you have a central entity that has the power of government, that produces it can increase the quantity of money at will, and to fix its price, that's called monopoly control from above. This is the same thing of Marxism, in the Soviet Union or whatever, where, well, in China, for example, back after Mao, Deng Xiaoping came in and he says, this collectivization of agriculture hasn't been working, so he privatized it. Well, what was the collectivization? It meant government determined the quantity of certain grains and the pricing of certain grains. Okay, so it created distortions, and even Deng Xiaoping said, no, it didn't work. But yet we have a central authority over the quantity and the pricing of money, not a market force. So take a look at a Fed funds rate chart. Go back 3/4 of a century if you want. Oh, have you got one there, Steve?
Yeah, I will pull one up right now.
Okay. This speaks volumes, because when we buy things or make economic decisions, family planning decisions, new home, buy some acreage, factories, add a new factory to our production capacity, new employees, et cetera, all these decisions are made. One of the key factors is the price of money. And if money is dirt cheap, then, oh boy, but if it doesn't, if that's a falsehood, then you've been, in effect, drugged for a long period of time. And if you go back, look at this, goes back to the 1950s. Thanks for bringing this up, Steve. Okay, look at the Fed funds rate then. Okay, now that's 75 years ago. Okay, so okay, but look at most of the rate levels of the Fed funds rate between 1970 and 2000 even. It's above that 4% level, and most of it's up around either side of 10%.
Yeah.
Okay. Yeah, right about there, 10%, right in the middle of all that stuff.
Yeah, this yellow line right here for perspective is where we are now, 4.3.
Yeah, 4.3. Even that is still historically cheap. Okay, even though they raised it recently up to 5 something, it didn't. That was hardly what you call pricey money, okay, historically speaking. But look at what happened from 2009 through 2022, except for a blip there prior to COVID. And then when COVID came along, they took it back effectively to zero. Okay.
Yes.
So you had free money for 10 of the last 15 years. Well, that's called Cheech and Chong time. Okay. Everybody's high on it and making decisions, many false long-term decisions about credit and so forth. So now we have a credit bubble, and it's not just government, it's elsewhere, but it's this time it's also focused in governments, not just US, but Europe and so forth. So it's a real credit crisis underneath the surface here. But this delusional pricing of money for 10 of the last 15 years, in fact, for the 15 years, and even that uptick doesn't change it, helped cause the bubble in the stock market. The money they printed, so to speak, you can see it in an M2 chart too, which goes parabolic.
Yeah.
That money went somewhere. Well, investors chose to put it in, especially in 2009, which was an appropriate decision by our metrics, into the stock market. Okay. Well, then the stock market was under 1,000 S&P 500, and they kept putting it in and putting it in and putting it in. And when they had a question about it back during the COVID drop, the Fed gave them incentive to put it back in again. Okay. Not only that, they cut rates back to zero, but they started buying ETFs, corporate debt related ETFs, to support that end of the market. So, like the BOJ has done for years, they practically own the Japanese stock market. So no wonder you had a stock market bubble. This is the drug addiction chart. This proves it. The problem is bubbles don't last forever. There's a point at which reality takes over. And it's not what's going to happen in the future that people are all focused on, like, oh, are jobs going to get worse, or is manufacturing going to slow down? I understand today the New York Manufacturing Index dropped sharply to, surprise number. But it's not the things in the future that will cause the market to go down. It's sometimes the things in the past that it shouldn't have done cause it to go down. The reality that's underneath the surface. So I know everybody's looking for data points in the future, but the problem is it's already been done. And once that bubble starts to technically break, and we define it now as broken, as of January for the S&P and as of 3 weeks ago in the Nasdaq 100, the leader index. We think the bull trend is now broken and we're entering a bear market. But the reasons aren't the things that are down the road. The reasons are the things that have already accumulated that need to be expunged, puked, etc. Just like 2008 and 2009. Errors created collapses. Okay, this time it's going to be far bigger. So that's my global view. We also see the same thing in Europe, Japan, India, especially the stock markets over there. They're indicative of that. The one that's interesting that is not a bubble is China. The Shanghai index, for example, right now is trading double the price it was in 2009. Only double. Now,
Do you have a ticker for that? I could pull that up.
SHGC sometimes. Anyway, but the point is the Shanghai did have an explosive surge back, I think it was in 2015 or something, and it collapsed back from it. But right now it's laying at levels that are only double where they were in 2009. So yes, while their economy
is this it?
South, yeah, that looks like no, that's not it. That's a specific stock there.
Oh, okay.
But anyway, the point being that it is not a bubble, but we all know the Chinese are having recessionary problems right now. And so the central government over there is doing what they've done in the past, though not recently, print, okay, to keep their real estate bubble from, puking up too much. But they'll no doubt go into recession if the world goes into one. They just won't have a stock market situation like we do. You don't always have to have that. But the Western world, as we call it, has a bubble. And so it's not just the US. So global view is we're topped. The bubble is going to break. The bubble is based on things that happened that need to be vomited up. And it'll create some pain on various levels, including personal levels, which won't be fun unless you're on the right side of reality. And that's what we're trying to advise our clients.
Okay, so basically, big picture view, you see that we've got bubbles going on across the planet, right? The U.S. kind of leading it, Japan and India pulling right up behind. This is something that is kind of unique in history, and this is one of the biggest bubbles that we've had. I mean, this has been going on since 2009. I can pull up the charts, and you can see it just goes from bottom left to top right for the last 15 years. And you got a bubble in the S&P, you got a bubble in the Nasdaq. Looks like they're finally starting to kind of roll over, and I'm glad to hear that. You know, I get your newsletter, and you and I are seeing the same thing, so that's really nice to have some conviction there. And also, when you have a government that has just had a monopoly on what the price of money is, and you just have free money that has gone on for so long, what happens is you get a lot of these zombie companies where people, you know, there's no penalty for bad investment because you can simply roll the debt over and it doesn't cost you anything. You mentioned something about corporate debt, and I've noticed that corporate debt has in some cases doubled in some companies. And do you see any like maybe arbitrage that we could play on that, some way to make money from possible corporate debt?
The sector that we're watching, I know everybody's watching the Mag 7. Okay, we're fine. You know, super. They were the leaders, so they'll lead the way down on a percentage basis. This is what happened at .com.
Yeah.
When we peaked in 2000, S&P went down 50%, Nasdaq 100 went down 82%. Okay, why? It was the leader upside, leader downside. Okay, same situation now. But you've got to watch the financial sector. And I suggest using XLF as an ETF of the broad financial sector. And the banks too, you can KBE, the bank ETF. But one sector we're particularly watching is commercial real estate. You know, not home mortgages, but, you know, large corporations that deal with commercial type buildings, shopping centers, factories, computerized centers, you know, et cetera, et cetera. They look very vulnerable. One of those I suggest you punch up is VNQ or RWR. They're both, yeah, there you go, Vanguard Real Estate's VNQ.
Okay.
Yeah, now see, in 2021, 2022, they made a high, but they didn't go back to the high over there. These are monthly, I can tell.
Okay.
Recent high was well below. In fact, it was only about halfway back to that high. Now, remember, the broad market exceeded that high, but commercial real estate did not. Instead, it went up to the same high that had occurred in about 2020 to the left. Almost looks like a head and shoulder top, right? You know.
Okay.
So it's a weaker sector. In fact, you could draw a line sideways going back to 2016 right now, and you've been kissing your sister for 10 years almost.
Yeah.
Up, down, going nowhere. It's a waste.
Yeah.
It hasn't broken down because it does move in sync with the S&P, the Nasdaq 100. It just doesn't move in the same dimensions upside. It ran out of gas in 2021, 22. Now, when you look at that price chart, you say, well, you know, we got to go way down to, you know, in the mid 70s or so. Right now it's 90 something before you even threaten the bottom end of that range.
Yeah.
When we do momentum studies of price is almost always a secondary indicator. In other words, it's lagged to reality. By the time price breaks something bleeding obvious that everybody says, oh my gosh, it's broken, momentum will have already done it a couple months prior, or maybe even further than that, and at different higher price levels. Right now, we're dancing on levels that will bust this thing wide open. So we're kind of focused on the commercial real estate, and you can go in and check out what the components are of this, but there are many big name companies that you'll recognize in the commercial real estate arena. And it's heavy in debt, and it's part of the credit bubble, and therefore that's probably why it's behaving as it is. But it's an area to watch, because if this sector goes, the whole thing goes. Can't let this sector go down and everything else go. It's not going to happen, okay? And if this sector breaks, the XLF is gone too, the financial sector, because there's too much. Yeah, now financials, see, they've been real strong lately. They went up above their 2022 high.
Yeah.
Now, over the last 6 months, they've wasted time. We've just had a sharp drop back to the low end of the past 6 months range.
Yeah.
And we're arguing basically at those lows you're at right now, right there.
Mm-hmm.
You don't want to go there and close a month down there. If you do, this thing's gone. It's going to
Yeah, there's not much to catch it until it gets way
Well,
down
that
here.
would be your next bounce point, but that's a pretty huge percent. That's like a 20% drop.
Yeah.
Uh, and by the way, that's what we're projecting right now for the S&P and the Nasdaq is that the lows we've just made last week, which were flat little congested lows for about 5 days in a row, with
Yeah. Okay, let
pathetic
me go to the
looking
daily here.
bottoming
There you
action.
go.
Yeah, you can see that it's all clustered. And so far, 5 days now, they're really not making much ground.
Yeah.
We think you could drop down ultimately before you get a significant bounce. And I don't mean upturn for real, but a bounce down around 4,800 on the S&P, which is to say, go back down to the 2022 highs. If you go to monthly, you'll see it.
Right here.
Yeah, there you go. That level there is about 4,800. In fact, we've got some momentum reasons to think you could go there. Not just the silly price chart reason drawn horizontal there. That everybody can see that.
Yeah.
But there's also some momentum reasons that suggest that could be the next catcher's mitt. It won't succeed ultimately, but it could be the next point where you get an inflection that really looks like something. Right now, I wouldn't look for that. Any rally now looks like it's the kind of thing that could be spent in 5-6 days. Same with Nasdaq. I think it could go down to like 17,000 Nasdaq 100 now. Yeah, there you go. It's 19.6. I think it could go down to that old high again in 2021, which was 16.5 area. I think you could see it get there. And look at its cluster of ink over the last 5 days.
Oh, yeah.
Little tiny clump of nothing spinning their wheels for 5 days.
Yeah. Yeah.
So anyway, that's what we think the next step is, but that's not going to be the bottom. I think that's merely going to be a bounce point. We think this is a bear market underway, but with layers. Most bear markets don't go from A to Z. Okay.
Yeah.
And this is where we expect next support to be at an obvious place on the price charts, the old 2022 highs.
Yeah.
And it's what we call an idiot point, because any idiot could draw that line. Okay.
Yeah.
And it actually might
I press
work.
alternate H and it's there.
Yeah. But momentum kind of agrees with that. So that's why we give it some credence that could be a bounce point. But that's pretty serious. Now, even getting there is not a crash. What's a crash? Back to 29, back to 1987, which I happened to catch. Not in a big way, but I caught it. .com. No, excuse me, the COVID event.
Yeah.
That was a crash type event. What I mean, 30 to 35% within a couple of weeks.
Okay.
Not 3 months, but a couple of weeks, in excess of 30%. Most bear markets don't begin that way. In fact, quite a few bear markets don't even have a crash in them, even though they're bloody. They never go down in that way. So people who think, oh God, if we crash, everything's going down, including gold and silver. Well, we've had a pretty good drop over the last 2-3 weeks, right?
Yeah.
What's gold done? What's silver done? What have the gold miners done? Gone straight
up.
Yeah, okay. And yet we've had one of the sharpest drops we've had in months. And yet gold and silver went up. Somebody didn't tell them, apparently. They're supposed to go down, right? Okay. That's another falsehood out there. Anyway, so that's what we see. We see a global downturn. And usually downturns like that, major bear markets, you don't see the data points that explain why, the future failure points that the Fed likes to look at. Manufacturing collapses, job and unemployment goes up, et cetera. They occur after the market tops. So we're betting over the next month or 2 and 3, you're going to start to see sharp rises in the negative metrics. The ones that the Fed will use as an excuse to what? We know what. Okay. Cut, print, maybe buy ETFs again. Who knows? I know they haven't wanted the cut because, frankly, they're at war with Trump. So, they feel like they'd be assisting him. But the reality of the data points is going to hit him pretty quick. And so we'll see what they do. But I suspect that the Fed, the ECB, the BOJ will all print.
Okay, so you feel like the the S&P and the Nasdaq, we've probably seen our top for a while,
Yeah.
and
Well,
that
maybe for years.
yeah. Okay. All right. Okay, this is good because this is going into some questions that we got. So The paradox, let me just make sure everyone's on the same page with this. I'm going to share my screen here real quick, and we're going to go over basically he's asking about the Qs. So the Qs is kind of, why do they even have this? Is this so people can run options on the Nasdaq, I guess?
Yeah, it's a option vehicle for Nasdaq. You can buy puts on it, et cetera.
Okay, yeah, because nobody's going to buy a
It's
put
the
on
Nasdaq
something that costs
100
$19,000.
ETF that you can buy calls or puts. Yeah.
Okay, all right. So this is basically the holdings of the Qs. There's 100 of them in there.
Well, it's the
Half
same
of
as the
it,
Nasdaq 100. Yeah.
yeah, and half of this is technology, and then you've got 15% is communication. So it has all 11 sectors, but you can see that like real estate makes up 1/5 of 1%. Yeah,
It's
essentially
the big names are up front. Look at the weighting too, about almost 9, 8, almost 8. The first three there is with 24% or something.
Yeah. The first three are a quarter of the entire thing. Yeah.
Anyway, in fact, that's a lessening because 6 months ago, I think the weighting up front was even more heavily weighted in a few stocks. I think they've actually sort of liquefied it a little bit there.
Okay.
But anyway, yeah. That's still you can see like 24% are three stocks. So.
Yep. Just anyway, a massive percentage.
It's hardly an index, Okay.
Yeah. Okay. So the paradox is asking you. You touched a little bit on this, but he says if the S&P 500 and the Qs are out of momentum, over what time period would you expect their prices to decline? You said quickly, but
the issue really, historically, if you go back, almost every bear market is 2 to 2.5 to 3 years. Okay, 29 to 32. .com was 2000 to 2002. 2007 to 2009. The issue isn't the time so much as the dimension of the drop, what percent, because that can vary sharply. Like the Dow 30 went down like 80% back in 29. Now, meanwhile, like I said, at .com, S&P went down 50, but Nasdaq went down 82. Similarly. So it's the percent drop, but also another factor, not just market, but the real world economic effects that collapse, corporation failures, credit failures, government credit crisis, something we've not dealt with. What's that going to look like? And the real world consequences. So it's not merely what the stock market does. It's only a small reflection of past reality, really. The other issue is how long does it take to get back up? I mean, is it quick? No, it isn't. You go back to 2000, and let's say we said get out in January of 2000. Well, we knew that it was going to hang around because we warned people, don't be surprised if it doesn't go down right away, but just get out. And sure enough, in August, it was making a new high. S&P did, like 5 or 10% above where we said get out. And it wasn't until 2001 before you really started the drop. Yeah. It sat up there for a whole year, flip-flopping around, making people feel good. Because, it wasn't dropping, okay? And then ultimately it dropped your 50% collapse, pretty big. But then it came back up, and if you didn't get out in 2000, it came back up to you in 2007, and you said, oh boy, assuming you didn't get out, okay, you're a long-term investor. We said sell again about 3 months off that high, and it collapsed. But it was till 2013 before you finally ever nominally took out that 1550 level on the S&P. That's almost, what's that, half of an investment lifetime of a wasteland.
Yeah.
Now, if you traded the swings, okay, fine. There was a, quote, bull market in between the 2003 low and the 2007 high, then another bear market, then another, quote, bull market. But they were all range-bound situations where nominally it was caught. Now, actually, in real dollar terms, I suspect you only got to new highs somewhere about 2018 or 2020 because the dollar, remember, quantity of money almost doubles every decade.
Yeah.
So if something's priced at 1,550 and 10 years later it's 1,550, it's not the same real value. It's probably about half the value in real dollar terms. But nominally speaking, even this is a wasteland. Now hit the Nasdaq 100, you'll see even worse wasteland
Okay.
during that same time period.
So 2000. Oh,
Yeah.
wow. Oh, geez.
2016 before you could get back there, and then you spent a whole year or two just trying to get through it. Again, nominally get back to the same price.
Yeah.
If you didn't get out at the right spot, and a lot of people believe just buy and hold, okay? Yeah, well, you wasted a half of an investment lifetime and more because in real dollar terms, you didn't break even until a couple years after that. So now during these same time periods, during that wasteland, what was going up? Well, from 2001 especially to 2011, gold was soaring during that wasteland. While the Nasdaq was laboring, gold was soaring. S&P was in a wasteland, gold was soaring. Back in the mid 70s, when you collapsed the stock market down to, in fact, you had a crash and tail end in 1974. While the stock market was collapsing during that 72, 73, 74 period, especially the 74 collapse, gold was exploding.
Mm-hmm.
So keep that in mind. If you go back to the 1920s, 29 to 32, there was nothing to own, right? Well, Roosevelt made it illegal to own gold. But home stake mining, the biggest gold miner around, went up 1,000-fold. Okay. So in every one of these major bear markets, there's been a place to be. No, not always day to day, week to week in sync. Sometimes there's even a month where they look like they're the same market. But in big trends, they're opposites. Gold was the safe place to be. Now we argue that it's even more so because now we have not merely a declining stock market with money scaring money out of that market into other places, but you have potential dynamics in the government debt market that are nightmare situations, which we're in different fundamentals than we were in any of those bear markets in terms of what's causing it, what the outcome might be. So the dimensions of gold on the upside, I can't even speculate except to say 2 times in the last 50 years, gold has made 8-fold moves. Mid 76 to 1980, 8-fold. 2001, 2011, 8-fold. Different time spans, but 8-fold moves. We're only 3-fold. Our bear low is 1,050, 2015. So we haven't even matched those prior moves. God forbid reality takes over and we realize the fundamentals are far worse than it was then, therefore justifies even greater move by gold, which I suspect could easily happen.
Okay. So wealth isn't created or destroyed, it's simply transferred. And you see a wealth transfer coming from the tech sector, the stock market,
Yeah.
into real things like physical gold.
Yeah, and commodities too. Commodity market has not been in sync with gold for many years. People don't realize that. Yes, in the surge in the 2007, 8, and 9 period, commodities went up with gold. Then they made a secondary lower high in 2011 when gold made a higher high. And then they all collapsed into 2015, right? Okay. But from 2015 to 2020, the Bloomberg Commodity Index continued to go down while gold doubled. Total opposites. No, commodities weren't collapsing. They were just bleeding every year for 5 years. And finally, in summer of 2020, the Bloomberg Index traded below 60. I need to make this point. You get a Bloomberg there?
There's the Bloomberg.
You see, you don't go back far enough. Okay. Way back in 2008, this index was up at 230 something.
Oh, wow. Okay.
And we dropped all the way down into this below 60.
Mm-hmm.
And so in its first inhale coming up out of hell, it ran up to 140. And everybody's, oh, commodities are off the page. They were still 140 versus 237 back in 2008. Then they pull back, and for a couple of years now, we've oscillated either side of 100, about a 50% pullback to that bear low, by the way.
Yeah.
And we're arguing that is a base. And while price is trying to come up out of it, hasn't quite achieved it yet. You need to get up closer to 110 to do that. Our quarterly momentum has broken out, and it indicates that we're emerging from that base. If that's the case, commodities then will coattail gold this time.
Mm.
Now, remember the last time that occurred big time, well, aside from the 2007-8 period, was in the late 70s when we had a global recession, stagflation. The stock market was a wasteland for a decade. It went sideways, teasing ups, teasing downs. But commodities exploded and so did gold. Gold leading, of course, commodities to a less extent. I think we're in that position again where this asset category, which is dirt cheap, saw its exhaustive bear low in 2020, had its first upside, I'm back, statement, pulls back, corrects bases, and is now ready to go again. I think the next move could be quite strong. It could easily take out that 140 and go, I'm not sure, but well beyond there. So we think this year commodities could be a place to be, but they're very secondary to gold in terms of potentials. Also, I think that energy complex, which sort of led that last move from 2020 to 2022, they were percent-wise tended to be stronger than some other commodities. Though it was
XLE, is that what you mean?
Well, that's not it. I would be looking. That's not in the Bloomberg, but oil itself is crude oil.
Oh, okay.
Yeah, the Bloomberg only holds raw commodities. Yeah, so oil had that surge from $10 to 130. Okay.
Oh yeah, that was the trade of my life.
That move peaked like a month or several weeks after the war in Ukraine, Russia-Ukraine war commenced. So they blamed that move on the Russia-Ukraine war, and yet when the war began, it peaked. It was a total falsehood. The reason oil went up was it's dirt cheap. It was an underpriced asset. It says no more, okay? And it did the same thing as Bloomberg. It pulled back, and now for 3 years has gone sideways in the mid-60s with rallies up into the 80s and so forth. If that price, which is still subdued, oil is still near the lower end of that range. And, therefore the oil stocks are waiting on it. If that next quarter, if it gets up and closes out a month, I won't get too specific, but in the low 70s, we get real specific with our subscribers. You're not taking out any of those highs, but quarterly momentum says you're out of here. You're going to explode up out of here. And so even then, the oil sector, the oil component of the Bloomberg will join in with the Bloomberg to the upside. So it'll be a broad commodity upside, though right now oil is the laggard within the commodity complex. Meanwhile, copper, for example, is pressing at all-time highs again.
Yeah.
$5. Grains have bottomed in our view. They could be more potent than energy this time. And so that's another place to be. The stocks that are related to commodities, such as the oil sector stocks or agricultural related, like fertilizer and so forth. There's an ETF in the ag sector called MOO, M-O-O.
Yeah.
It contains companies that are involved in the agricultural business. So those are places to quite possibly be this year. But again, our argument is monetary metals will beat everything.
Okay.
And we think within the monetary metals, while gold is the mama, it will be outpaced by silver and the gold and silver miners.
Okay. Well, that is music to everyone's ears watching this show. Okay. Alfie has a question. Let me do a quick, just make sure everyone's on the same page. So he's asking about stagflation. And so stagflation is basically slow economic growth, high unemployment, meaning a lot of people don't have a job, and high inflation. So horrible time for John Q. Public, but an amazing time if you're a contrarian investor. So he's asking, basically, he says, can Michael tell us about the momentum structures in energy and whether the structures in energy, coupled with what we're seeing in the major indices like the S&P 500 and the Nasdaq, support the thesis that the United States is currently in stagflation?
Well, movement of markets doesn't necessarily determine economic notions like we're in deflation, we're in a recession or depression, or we're not in one. You can quite often go into a recession and yet commodities, including what they call Dr. Copper, remember, is associated with the economy. He's looking real strong and yet the economy's looking weak. And this has occurred many times before. So don't try to connect the notion of going into economic downturn with downside pressure on commodities. especially looking, like I said, at the Bloomberg, look at its price level. Just be an idiot and say, are commodities really high priced like everybody claims? No, they're in the lower half of their reality in the last 20 years, and they're likely to go up and challenge those highs. And they're only, right now, they're low risk buy, and we're getting the technical information that we want out of most of them and the Bloomberg, and oil will contribute to that, we think. And once oil engages, that'll be like a full deck in terms of the commodity upturn. And it could very well turn up during economic downturn. And if you look at what's going on actually since, let's say, 2020 through the 2015 to 2020, when commodities went down, stock market was going up, economy was good, right? But how come commodities weren't going up? So don't make that mistake that economics has to do with commodities. It might in terms of supply demand issues, but quite often there's bigger issues at play, especially when an asset category is priced historically low and another asset category is priced off the page. Okay.
Okay. All righty. And Morton wants to know, well, he asks about, do you have a number plus or minus at which you think the S&P 500 topped out? And you hit that. You said you think it has.
Yeah.
He says, is there any time soon that long bonds are going to be attractive as the S&P 500 breaks down?
Yeah. T-bonds are also have tended to be an option to be in like 2000, 2002, be long gold and T-bonds. 2007 to 2009, be long bonds, not the S&P. And lately, though, it's only been gold. And now T-bonds, we got bearish on T-bonds back in 2020. Price of T-bond futures then was 170. They collapsed down close to 100 by 2022, in the low 100s. Bounce, came back down in 2023, bounce, back down again. They're clustered at very low price levels, basically, 110 area on the T-bond futures I'm talking about. So yields are chokingly high on the longer end of the debt market, which of course doesn't help debt such as commercial real estate debt, which is long-term debt. Okay. But it looks like to us, and by the way, when the Fed started cutting, a couple, back in September, I think it was,
yeah,
T-bonds went down, price yield went up. And did just the opposite of what the Fed did on the short end. Okay. So don't look at the Fed as the clue to what bonds are going to do. But bonds have tried to turn up recently, and we've argued that technically it looks like they're going to try to participate as an alternative to the stock market. So as we see fragmentation in the stock market, some of that money traditionally will go into T-bonds as the alternative. It's always worked, right? Okay. However, the break that occurred in 2020 destroyed a multi-decade trend in bond yields and bond prices, such that if you get a rally now and a drop in yields on the long end, treat it as a trading situation, not as an investment. I don't think it's a multi-year upturn. I think it could be a couple quarters, but it's a trading rally, and I don't think it's going to sustain. I'm suspicious of it. I am not suspicious of gold sustaining, but I am suspicious of T-bonds. They're going to try, just they normally do. T-bonds and gold go up together in these times. But this time I don't trust the sustainability of the T-bond rally. Enjoy it while it happens. And so far it's floundering, but still hanging in there enough to us to say plus. But again, it's a counter trend plus. Okay.
Okay. We asked Vince Lancy the same thing, and he basically said, yeah, this is not a bet. This is a speculation and a trade, and a short-term one at that.
I quite agree. Yeah.
Okay. All right. Okay, moving on to precious metals. Syme wants to know, he says, if there is a significant drop in the stock market, does Michael think that gold and silver miners will drop at the same rate? If so, would it be sensible to sell now and buy back cheaper?
No, I don't think that correlation is any good. In fact, I think it's mostly the opposite. As we've said, go back and look at those bear trends. Big picture. Don't look at day to day, week to week, or even month to month. Look at the big trends. 2000, 2002, and it stayed in a wasteland till 2013. Well, during most of that time, gold was going vertical, eightfold. Okay. The collapse into the 74 low, gold was going vertical. et cetera, et cetera. Okay. 79 to 80, stock market wasteland. Gold went up. Okay. And right now, the stock market broke hard the last few weeks, pretty hard. Not a crash, but pretty hard. Surprising to many for some reason. Gold went up. Silver went up. Miners went up even more on a percent basis. How come? It's not supposed to happen, right? Well, that truism is a falsehood. You'll find some instances in history where, for 1 month in a bull trend, gold went down hard with the stock market, but it had nothing to do with the major trend. So don't be confused by that. You'll miss the move. That's our view. We stress it over and over to our subscribers, and it turns out we're pretty much right. It doesn't correlate to the stock market. In fact, it's helped by the breaking of the stock market. That's been our main point for months now, that the fuel to get gold going vertical is to punch a hole in the stock market so the money flees and goes into gold. Seems to be happening.
Yeah. I'll do a visual representation of that right now. And this is gold divided by the S&P 500. And
Yep,
I've had this 50% mark here drawn forever. And we're finally
it broke out last month. Yeah. Mm-hmm. Yeah.
Yeah. It's been amazing. The last time we were here was what, 4 or 5 years, 4 years ago. And
in fact, you can go back further, but the point being also, go back, you can see at 2018, 19, there was a low, and what was that low? That was the low.
Yeah.
No, your low was in 2022, but basically gold's gone sideways there.
Yeah.
Okay. What does that mean? It's been part of the S&P. Even though it's low on the spread chart, it's not going down versus the S&P. It's been mostly going sideways, especially since 2021, in a little range. Now it blew out of that range. Well, it's not only been in the range, but in the upper part of the range, whereas the lower part of the range was down there at 38%. The upper part was at 48%.
Yeah.
That's a pretty big move.
Yeah.
It doesn't sound like a lot there, but when you look at it's like that's buying a stock at 38 and it's at 48. You do the percentages, okay? That's how much gold was already beating the S&P, even though it was still in that range. Now it's broken out of the range. There's some other metrics we look at that suggest it's much bigger than it looks. You're going to come up out of all this ink.
Okay.
But also another point about these spreads, quite often when they occur, these relative performance charts, it indicates an increase not just in the spread relationship changing, but in the actual net price dynamics of the markets. In this case, more down S&P, more up in gold. Now, I've got some other spread charts I sent you that are the main point I would like to impart about where to be this year.
Okay.
Silver, gold, or the either one you want, or the gold miners versus gold. Either one.
Okay, let's bring up the silver, gold, and bam. Okay.
Go back 50 years, actually 51 here, 1974.
Mm-hmm.
And all these graph bars show each year what was the highest level during that year that silver was in relation to gold as a percent. So back in 74, it was up to like 2.5% of the price of gold at the best reading of the year.
Mm-hmm.
And during that bull move that went from, up to 1980, it was up to 3, 4, finally up to 6.5%. Wow. Silver was $50 then, but it was priced in relation to gold, divided into gold, expressed as a percent, 6.5%. Okay. Then after that bull market ended, the spread also retreated, meaning silver started to give back its performance gains versus gold. But notice that in 1998, 2000, gold was just floundering around. It got up again. Silver got up again to 2+% of the price of gold.
Yeah.
And it pulled back again. And then in the bull trend of 2000 to 2011, you'll notice that in 2 of those years, the last 2, it got up over 2 and got up to over 3.
Yeah.
In that bull surge. But the point of that red line, the red arrow, is that 21 of the past 50 years have at least been 2% of the price of gold. Now, some of those were bull market years, but most of them were just normal years. There was nothing particularly dynamic going on when silver in 1988 got up to 2% or whatever. 21 of 50. So it's not an abnormal spread relation. Right
Yeah.
now, 1.145, or let's call it 1.15. Okay. And you can see for the last 3 years, we've been about the same level, very low. We're monitoring this spread relationship on a closer basis, week to week, day to day, and so forth. And we've gotten a daily breakout. It suggests that the decline of since late last year is over anyway, and we're headed back up. And we've got some other levels on the spread versus silver versus gold that say, we're on our way to 2% again.
Mm.
Well, now, that's not a big deal. To claim you're going to 2%, it's like, oh, it's going to some normal level. Well, that's almost a doubling of current value of silver to gold. So, going forward, if gold goes up, another 1,000, 2,000, 5,000 bucks, silver's going to go up that percent plus twice if it goes to 2%. So that's a hell of an advantage in the silver situation. And we're technically watching this for credible upturn signs, and we're very close to them. We update them in our reports. So this is an area we'd be watching to participate in the monetary metals, but on the silver side of the equation. Now, the other chart is similar.
Okay. And XAU versus gold?
Now, XAU index is the Philadelphia Gold and Silver Miners Index. Okay. Has quite a few silver miners in it. This is the month-to-month spread relationship, close of the month. Where is XAU in its relation to an ounce of gold? Well, during the years 1984, which is when this chart starts, all the way over to 2008, it lived above that red line, meaning anytime it got down to around 17%, XAU price expressed as a percent of the price of an ounce of gold, that was a low level. And it would shoot up routinely above 30%.
Yeah.
Or in the latter part, they're up into the 28, 27.5%. So still, they lived above those levels. In 2008, it peaked relative to gold and dropped all the way through 2015, where the red arrow is. Now, that was December 2015. That spread bottomed the same month that gold bottomed in price. Gold was 1,050 then. And XAU, which is now trading at 170, by the way, was 45 at that time. Okay. In the 10 years since, that spread has lived mostly above that low, meaning the gold miners have actually done better over the last 10 years than they were in December 2015 relative to gold. So if you bought that low in late 2015, you're making more money in the miners than you are in gold, believe it or not. It's a measurable fact. Now, the question here is this. This looks like basing action. 10 years sideways, they've tried to take it down. I mean, what are you going to do? Go to zero? Okay. This is what you call freebie. Okay.
Yeah.
Buy cheap. Well, it's proven I'm not going down anymore. I'm not going to zero. Okay. I'm real. It has a downtrend line that it's eaten its way out above. Okay. That's step one.
Yeah.
And then there's the top of the range that's up around 8%. Right now, we're pushing towards 6%, I think.
Mm-hmm.
That chart's a little old. So you're not out of the range yet. But from the current levels, if you even broke out of that base and just said, oh, I'm going to run up and bump the bottom of the old multi-decade range and fail there.
Yeah.
Okay. That's a tripling in the current relative valuation of the miners to gold. And we're arguing that's quite often the case late in the bull trends where while gold continues up and up sharply at that point, like in 79, it went vertical. Well, silver went more vertical, and the miners did too. But this looks like a situation where you're dirt cheap on a relative basis. You've proven you're not going to go lower. The only issue is when you're going to break out. And we're measuring that. And when it occurs, and we've already got a breakout of GDX versus gold, and XAU is doing similar action. We think we could triple the gold miners and silver miners relative to the price of gold. So yeah, gold's the mama. Watch what it does. It's a leader, but it won't be the leader in percent terms as these spreads break out, the silver situation and the gold silver miner situation. That is, I think, the better place to be in 2025.
Okay. That is music to our ears. So basically, you see that the miners are going to finally start outperforming the metal. And also, maybe I can bring up I have a ratio chart here that I think explains basically what you're talking about in the percentage one that you were showing us on silver versus gold here. So this is simply gold divided by silver. And, we're up floating around 90 to 1, but you're saying this green line is nothing compared to where the average is. The average is kind of down around like 50 to 1.
Yeah. In other words, we think that what we see as a bottoming pattern by the way we measure it, which is divide silver into gold. This is the opposite. This is the ratio thing. And that's fine. This is a topping pattern. And you're right. There's a range there. And I think that you could probably draw a little steeper line, forget that line you've got, but just the last low there, that last low that poked down under there. Draw a little line under that guy.
Oh.
And what are these durations? Weekly or what?
This is weekly, yeah.
Yeah, okay. Well, that's a good period of time there. Okay.
Yeah.
Is that about almost 3/4 of a year or so? You could draw an uptrend from that low through all the recent lows up through the present. Yeah, something like that.
Yeah.
Watch, because this thing has tried to get back to that secondary high that occurred in 2022, but couldn't do it.
Yeah.
And now it looks like it's saying, oh, okay, I'm out of gas. I'm going back the other way down, meaning silver's going to outperform.
Yeah. Yeah.
And we're measuring that in a different way, but and also with momentum of that spread, not just the spread itself. So anyway, yes, we think that is the better place to be.
Okay.
And that suddenly silver will have stories attached to it that might even be outside the context of monetary metals issues, but might something to do with industrial demand for silver or unique supply demand problems. We know that annual production of silver is basically flat to down. It's not been increasing, and demand is increasing. So that's a separate issue from the monetary metal side of silver that could come into play and would not surprise us. But that's where we want to be. In fact, I personally, my emphasis is on silver-related ETFs and options, and also on silver miners.
Okay. Awesome. All right. This goes right into Ingersoll's question. What gold-silver ratio would Michael start trading his silver into gold?
Don't have a target, really. There's a point at which in this next bull market, and it's hard for me to explain this because I've hinted at it. This is different this time. I don't think we're in another bull market in gold where you peak and collapse. Okay. I think reality, political reality, economic reality, the trends of statism worldwide are changing. That certain norms, decade to decade, repeated and increased, will shatter. Because to the extent that they were wrong, bad ideas, bad institutions, bad policies, and bad results, it won't work anymore. And when it breaks, it breaks. And at that point, people get emotional. They look for alternatives. And they may not be quite sure what that is, but it's something else. And I don't think we're going to return to another, the Fed's going to print us out of the hole again. We're going to have another boom-bust cycle. In fact, I've made statements to the effect that, and I'm not advocating, I'm simply looking from above and determining, over a year, I've said they'll abolish income taxes. Well, Trump said he'd do that anyway, going to go to tariffs. And why hasn't he done it? Well, I think it's the arrow in his quiver that he's saving, because it's the one thing he can do that if the other things he does cause pain, because when you get rid of bad institutions and things fall apart. People think, oh, you did that. Well, maybe they should have come apart in the first place. Who knows? Let's don't get involved in that. But it puts frowns on people's faces. I mean, the one thing you can smile about has been your retirement account. Oh boy, it went up 20% last year. Green. All of a sudden now down 15% or so. Ooh, when that occurs, fear comes into play. Uncertainty. The other thing, and if he can offer that to the average American, that puts a smile on everybody's face because it's instant gratification. Oh, ultimately you may pay more in tariffs because of, the cost of goods and so forth and so on, but it provides an instant smile. So he may be holding that back as an instant smile tool. Okay. I think they're going to abolish it anyway at some point, especially as we go into the downturn. Why? It's dysfunctional. The IRS is not really functional in terms of getting what they're supposed to get out of the public. And now, especially that they're cutting the IRS payrolls, the number of employees, their ability to audit and so forth is collapsing. Okay, so it's a dysfunctional agency in terms of what it's supposed to do for the government. Tariffs might offset that. I don't know. That could go by the way. The other thing I think will go by the way is the Fed. The Fed's been around for 100 years, a little more, one very long human lifetime. Okay. And a lot of people realize that it's the father of the boom bust cycles. You look at the M2 chart and basically see it. Okay. They create these great river flows of money and you get a big stock market boom, but then the stock market boom doesn't last. It breaks, goes down, then they start taking the money rates back down again to try to stop the next breakage. It's a repeated game. I think the support for the Fed is starting to erode, especially even among people who've long supported the Fed. And if you get into this crisis, as I think we will, not just the market downturn, but the other factors, people will say, hey, this hasn't been working. I think Fed will be gone. So a whole lot of institutions and changes will occur in the world that things we assumed would always be there won't be there. You're seeing it here and there, like Javier Milei in Argentina. I wrote a book 53 years ago defining the concept of anarcho-capitalism. Here's a guy runs for president, declares himself an anarcho-capitalist. Great.
Yes.
He defeated two major parties, like Democrat and Republican, been prevailing down there for decades, turned the country into a third world country. It used to be the seventh biggest economy in the world, decades and decades ago. He's bringing it back. He's slashing government. In fact, I think it was a Newsweek online thing. I think it was Newsweek. They even had an article praising Javier's success, which has shocked me that the mainstream liberal media would say this, in collapsing the price of housing, because the government had controlled housing by rental controls, which had kept prices high, actually. And so less income people in Argentina were really hard up for good housing. It was the most costly thing in their life. He's collapsed it, and this is several months ago, 20%. Okay. He ended that government agency. But he came out of nowhere. He didn't even have a major political party behind him. And yet the young people of Argentina said, we're sick of this. We want something else. He looks like a rock star. Okay. Let's just do it, okay? Without really having he had an idea, but they didn't quite know. They just knew he was different. So again, this shattering of norms, you're going to see situations like that in Europe, where all of a sudden something happens there where the orthodoxy is kicked out of power. You may not like the insurgent force, but whatever, things will change. And this is all part of what we're seeing here. Therefore, when gold reaches the new stratosphere, it might be institutionalized up there. We might find many major government currencies not being fiat anymore, but being gold-backed currencies.
That would be a heck of a change, especially ending the Fed. Man, that hashtag might actually come to fruition. I don't know what the odds of that are, but I would trade my left arm for that. Okay, Michael is asking. I'm sorry. Fiat is Dead is asking, Michael, how do you interpret the extremely high gold to oil ratio? If we get a mean reversion with oil going higher, will it hurt the gold bull market? And
I don't think it'll hurt gold. Well, it would. I agree. Oil is low relative to gold, and I don't know the extent to which that is economically an issue. Because I understand the relationship of the monetary metal and a monetary metal, silver to gold.
Yeah.
Well, therefore, gold miners to gold. That makes sense. But oil and gold, that's like comparing what's the price of corn in relation to gold.
Okay.
You'll probably see a same picture. So, or the price of cow manure. Literally. Any commodity, anything of real value measured to gold is probably cheap to it, and so forth. So I don't know what the economic consequences would be. I don't think it would have a market consequence. And yeah, I agree. Oil is cheap in that measure. And therefore, that helps probably put an undergird under the oil market here at these levels in the 60s, for example. I don't think it's going to 20 again, okay. So, it's either stopping here, going up, or, I'm totally wrong, which I don't think I am. But I don't know about that relationship, and I don't have any sense that, certainly not that if oil goes up now more than gold on a relative basis, that's going to hurt gold. No.
Okay. All righty. Quick thoughts on copper. You mentioned that you thought we're probably not going to have, wow, we're touching almost $5 here as we
it was
speak.
under 4 several months ago.
Yeah, we're at $4.90. We'll round up 98 cents. Macro thoughts here on copper.
If you go back to 2011, if you can do that, you'll see something else.
Okay.
Back then, what was copper? It was like 475 or something. Okay.
Yeah.
Now that's when gold, by the way, at that same time was 1900. In the 2011 peak. So they were in sync at that point. And copper also went down through 2015, along with gold, and then went into this stabilization period when gold did too. Gold wasn't back up to 2000 again until 2020. But while gold was at 2000 into the year 2020, look where copper was. It was back on the low again.
Yeah.
That's shortly after when gold was back over 2000 in the summer of 2020. So gold doubled during that time, and copper tried to go up and went back to the low instead. This is reflective of the Bloomberg Commodity Index, by the way, which we talked about before. It went down during that time, too. And then copper fully participated in that insurgent move from late 2020 to 2022. It exploded.
Yeah.
It went up and you nipped out the 2011 high.
Yeah.
Finally. And then dropped. Look where you fell. You fell right back on top of the range. Kosher, fine. And you've gone back up now repeatedly to the 5 level. Okay, that's a bit too many times.
Yeah.
Meaning that doesn't look like a top anymore.
Yeah.
That looks like an accumulation range and a distribution zone at the high, meaning it could be a launch pad.
Yeah.
I do not see copper at all outpacing gold in terms of percentages. But it is a component of the Bloomberg. And you can see here, unlike oil, which is near its lows in the last few years, copper's pressing multi-year highs. So it is definitely a strong component of the Bloomberg Commodity Index. It's contributing to that firming. And it is not going down with the stock market. You can see the green there. Okay.
Yeah, it's doing the opposite.
It's supposed to go down with the stock market. No, forget that. The question is now, the other point to say is, well, how come silver isn't back to where it was in 2011, which is $50 or so? And how come it's only, at this shelf at 34, 35 area, 33. And that also looks like a launch pad, and I think it is. But silver's way lagged to copper in terms of getting back to those old highs. This next move in silver, and I would say that, that idiot 35 level, which somebody sold, some people like round numbers, okay? They made some money for about, 3 or 4 or 5 weeks, and then it got all taken away again, and you made new high weekly close several weeks ago, and now you're pressing at the highs again. If you close a month out over that 35, not because it's a price level, but because we've run some other charts that say if your price goes above that high, certain momentum factors say you're going to launch. And this time when you launch, you're not going to go up in this staircase manner. 4 steps up, 2 steps back, waste 2, 3 months, 4 months, whatever. Instead, you're going to get something far more accelerated. And I'm going to bet you get above that 35 again, those old $50 highs, which are really sort of idiot levels because they go back to 2011 and 1980. Okay. It's sort of ridiculous. Those are old norms, not current, and they didn't stay up there very long.
Yeah.
I think you're going there and going through them.
Okay.
But the question is to get through this last little shelf. And you can sort of see where it's cresting. There's some old, once you topped back in 2011, there was a congestion zone below there that tended to stop where we are now.
Yep. Yeah.
So they're selling that same level probably too many times now. Okay.
Okay.
First time worked okay. Second time, don't count on it.
Okay.
You clear that, I think you'll gush past 50. I don't think you're even going to pause at 50. And that would be part, again, of that spread relationship of silver to gold. Where gold might go up 1,000 or so in that time, but silver goes from 30 to 50, that's a much, get the point.
Yeah,
But
that is a quick correction down into this range somewhere down here.
yeah. Oh, in terms of the spread. Yeah.
The spread. Yeah. Sorry. I moved to the spread
right.
real quick.
I thought we were looking, agreed. And back into the norms again, So, 40 to, you do the math, you get down to that 40 level again. Well, you've cut it in half.
Yeah.
Well, that's like going from 1% to 2%. Okay. On the other R charts. So anyway, I think that's pending. And I think the key factor to get that going has been punching a hole in the bubble of the stock market.
Okay.
So money starts to flow elsewhere. And if you look across the spectrum, it ain't flowing in too many places. Gold, T-bonds to some extent, some commodities. It's not evident yet on most commodities, but on the Bloomberg, but it's evident to us on the momentum. So the money's starting to flow out of that broken asset category into other places, and it'll get more exaggerated.
Okay. Quick macro thoughts on uranium. What it seems like uranium has had a bit of a. Do you want me to bring up the?
Yeah, if you want to. Where is it right now?
Here's this. Yeah. I could bring up URA. What would you like?
URAs. You just use uranium there. If you go back to 2017 and 18, it was trading just below and just above 20.
Mm-hmm.
Okay. Yeah, I think it was in 2018 we put out a major report, an annual momentum breakout, meaning price in relation to a 3-year average on an oscillator. There was a downtrend structure that came out there, and we stayed bullish all the way up to over 100. And when we first dropped off that high, when it got into the mid 80s, we said, uh-oh, we are going to correct. It'll look like a bear trend, and it could be sharp, and it could get down into the high 60s. It's actually gotten down to the lower 60s. And we think it's basically a major correction within the uptrend, but it is not a place to be buying until you see enough evidence of the upturn, both in price and on momentum. And it's going to take a little work. So this guy has done his first job. He said, no, it's ridiculous. 20, I used to be 100 and plus, and I'm at 20. Okay. Green world be damned. Well, anyway, so we now know that some major companies are starting to rebuild nuclear plants and so forth, as I understand. And nuclear's come back. It is, after all, one very safe method of generating energy. In terms of lives lost compared to oil industry, even compared to coal mining, it's very safe. And so it's back. And I think this is a corrective pullback, but I'm not interested in buying until I see stabilizing action, some momentum evidence of an upturn that looks credible.
Okay. You're waiting on the momentum
I'm waiting
to
on
shift to the upside. Okay. And wrapping up here, Gold is Money wants to know. I thought this was an interesting question. He says, Michael, you stay so measured, unemotional, unbiased in delivering your message while having lived through such a disturbing time in our history. He's basically asking, like, how do you keep your kind of, your stable mental attitude and when you're risking your money? What's your secret?
Well, the first thing to do to keep from getting too emotional is try to be on the right side. Okay. So if you generally can be on the right side, you're tending to smile more often than frown. Okay, so that's one step. And generally, we're on the right side. Okay. Right now, I'm most narrowly focused I've ever been. In other words, I'm not short the stock market, even though I think it's going down, because, if it goes down 50%, silver ain't going up 50%. Believe me, it's going up a lot more. So I'd rather be long the silver than short the stock market. You get my point. So I've never been so narrowly focused, therefore seemingly risky to be so narrow. But I think we're at a point in history where certain things I've thought were likely to happen. And I base my thoughts off of combining the philosophy of Ayn Rand, chopping off her politics and adding Murray Rothbard's economics and politics and anarcho-capitalist concept, again, which I wrote 53 years ago when I was in my 20s. Can't believe it. And now it seems to be happening. Decade after decade of statist growth, errors created, economic distortions created. It's finally coming apart, so I smile. It's not because I love it. It's because, reality's taken over, as it should. That's taken a long time, and that means it's probably going to be even more painful than if it had been a less long time of error. But I said before, this is, if you've ever read Atlas Shrugged, when you get into part 3, final part of the book, that's when the chaos hits. Where you see the reasons for it in part 1 and 2, and then suddenly in part 3, the whole thing collapses, the things that it should. It's compressed. It's no longer incremental. It's sudden. And I think both Murray Rothbard and Ayn Rand, who are past, would both be smiling right now because they knew this would happen at some point. The unreality can't prevail forever. So that's why I sort of smile. And, I'm sort of above it in the sense that I try to insulate myself, but I sort of understand what I think I'm looking at here. Okay.
Okay. What I hear is you basically devoted your life to this and you study it. And if you're on the right side of the train.
I don't let it get involved in our technical work, believe me. There's times I've been major bearish on gold, like in 2011-12. We, right off the top, 3 months off, we said, that's it, it's bear market coming. Took it a whole year before it finally collapsed. But that was the top, had been seen. So we stayed bearish till 2015. Got bearish in 16. So I am, even though it's a monetary metal, and long term it always reflects the decay in the money, I didn't get attached to it. So I didn't let my philosophical ideas interfere with my technical work. I never do. It just so happens now they agree. Okay.
Yeah. We're at a moment in time now where it's all adding up, and this is the right move. Yeah.
So, awesome. Like Patton, you ever see the movie Patton? He goes out on the battlefield at night after a battle had already occurred, and there's tanks, a bunch of American tanks blown up. And after he talks to his aides, he turns away and says, "God help me, I love it so." Okay. All righty.
That's a wonderful movie. Okay, if people want to follow you and your work, what can they expect when they sign up for with you at?
Well, we look at all 4 asset categories. So, we're not just focused on gold or silver. You do that and you'll make mistakes. You got to look at all 4. And we put out about 5 reports a week, including a very long weekend report, which summarizes most of the categories. Once a month, we put out a portfolio grid where we look at the big asset categories, whether you should be long-term, short, intermediate term trend, et cetera. So, we try to give a full view, and we also look at foreign markets. Yeah. So anyway, it's not real cheap, but it's lots of stuff in it. Okay.
Yeah, I get your newsletter and I love it a lot. I recommend it. It's a very, very, very concise and very exact. When I look at some of the price points on stuff, I'm like, okay, and then you come out to the penny. And I'm like, wow, you guys really get into the weeds here. It's impressive. So, thank you, Michael. Always a pleasure. Thank you for coming back on the show.
Thank you very much, Steve.
Yes, and thank you for tuning in. Be sure to support the show and share this with anyone that you think needs to hear it. It's probably your buddy that can't stop talking about tech stocks. You have yourself a great rest of the day, and we will talk to you next time.